Hey everyone, this is Kirk here again at OptionAlpha.com, and in this video update I want to talk about how to use advanced or contingent orders in your trading. Now, contingent or advanced orders allow you to set order triggers for stocks and options based on the price movement of the underlying stock, ETF, index, or contracts themselves. Now, nearly all of the trading that I do personally here on the order entry side, I'll use limit orders. I'll never use market orders. And today we're going to cover the four main types of contingent orders that you might use in your trading. So the first one is really a single contingent order. And what the reality is that most of us are actually using this. We just don't even know it. We use it mainly when we try to offer a price or fill a trade at a price that's maybe a little bit higher or a little bit lower than where the market is actually trading. So if you think about, let's say, an options price, you could, basically say that the options price is here at number 1, and you will buy the contract or sell the contract whenever the price gets up to whatever you determine. So maybe you want to buy or sell the contract when it's $1.25 or 1.25% higher, whatever the case is, $1 higher, $2 higher. You could also do it in reverse. So if you're looking to get into a trade where you're buying options, you could look at the option and maybe the option price is here, and you'll only buy it once it reaches some certain level, maybe $25 per contract. Okay, so there's single contingent orders. So let's actually go through an example here on my Thinkorswim platform. Today we're just going to use Apple as an example for their options. And right now the market is trading live. This is where Apple is, about up 1% today based on the time that we're doing this video. But let's say, for example, that you want to get into a credit spread in Apple. So you want to sell the 115, 120 call spread in Apple. So you do that, you bring up the order here, and you can see that this order naturally defaults to a single order. That's what most broker platforms do because they realize it's the most common type of order. Now, right now, the market is trading around 104, 103. You can see this price is probably going to start moving as we're talking about it live time. And you'll see here, at least on Thinkorswim, that the padlock is open, meaning it's live real-time pricing. We haven't locked in a specific price that we're going for. So if we wanted to get into this trade, we could use this limit order that we have right now to get into the trade at the market price right now, or at least try to get into a trade at the market price and see if it fills. Sometimes what we'll do though is we'll try to stretch and reach for a higher credit. And this is an example of using a single contingent order. So let's just be really exaggerated here. But again, the market is trading right now at about 103. Let's say that you'll only get into this spread if it's at 130. All right, so I might not do this in a regular scenario, but again, just to really kind of exaggerate the process here. And you can see, again, what we're going to do here is we're only going to sell this vertical call spread in Apple if the price of the security gets up to 130. Now, remember, the price of the security right now is trading, or the spread's trading at 103. So this is a contingent order that says, get me in, but only if it gets up to a certain price in the future. We use these a lot actually when we're trying to stretch for pricing. So sometimes we'll stretch maybe a couple pennies higher. If the market's trading at 103, maybe we shoot for 105 or 106. So something a little bit higher and try to, kind of reach for a higher price, let the market kind of come to us in a sense and try to get a higher price point. Now let's take the opposite trade, for example. So let's say that we're, maybe bearish on Apple and we want to buy a debit spread. Okay, so now we're buying options and we try to buy the 110, 105 put spread. It's trading right now for about 202. Again, you can see the padlock is open. So now we know that, this is the price that the market is trading at. And again, this might change. But let's say instead of paying 102 or 202 for this thing, you want to pay, again, something really exaggerated just to prove a point. You'll only pay 185 for this spread. So again, if we hit confirm and send, you can see this order is only going to get filled at 185. Remember, the spread right now is actually trading for 202. So this is your contingency on the downside when you're actually entering a trade that you'll only get filled at these prices. The way that we use these here, as we talked about in the previous video talking about options pricing, is basically setting a price that's fair and appropriate for the risk. So usually with credit spreads, because we went through a lot of examples with credit spreads in the last video here in track 2, what we would do is we'd basically set a price, let's say for this credit spread, set a price that we think is fair. So if we think, a 125 credit is fair based on the probability of being in the money or whatever the case is, we'll set that credit and kind of let that trade work, okay, for a little bit. And again, we're not going to try to set it too far out of bounds from where the market is right now. So if the market is, $40 or $50 off, there's probably low likelihood it's going to get filled. Don't waste your time in setting a contingent order that high, or, if the market is, $30 off and you're trying to buy it for $60 lower. Don't waste your time trying to set an order that's that far off. So maybe $10 or $15 at the most, let the market come to you. It's a really good way to use these contingent orders on the single basis, for order entry and kind of save time, especially if you work a day job or can't get to the market all the time. Now, the other type of order that you can have are multiple contingent orders, okay? This is an example of a multiple contingent order with stock, but it kind of proves a point, then we'll look at it with options. But let's say that the stock right now is basically trading at $25. Well, you could have a contingent order to sell out of the security at some price in the future, maybe $32 above the market. So whenever the value of the option goes up to 32, or if the value of the option goes down to 20, or the value of the stock goes down to 20, then you have an order to sell down there as well. So basically 2 exit points for your trade. If the stock goes up, you can sell at a profit. If it goes down, you can sell it at a loss. You basically have these multiple contingencies that go in with an order. So let's look at an example of that on our Thinkorswim platform. And again, we're going to use Apple here as the example for everything that we do, just so we stay consistent. And we'll still sell that base order of the call credit spread in Apple, which is the 115-120. In this case, what we've done here is we've actually changed the advanced order type from single to first triggers all. So you can just do this here. Most option broker platforms have the ability to do a single order or first triggers all. There's a bunch of these which we'll continue to get through here in this video. First triggers all means basically once this first order gets filled, so this order that we're going to place here first, it's going to trigger a series of other orders, and there can be a lot of them that come behind it. We'll only do 2 in this example, but it's going to trigger a series of other orders that are now going to work after the first order gets placed. And this is a great way to use these advanced order features if you are working a day job or if you don't have access to the markets. You can basically say, hey, look, as long as I get into this trade, also place the contingent orders for my profit target and for my exit of the trade if I want to use a stop loss or whatever the case is. Okay, so again, this is how we get it done. So the first order gets in and we want to get it filled at whatever price. Let's say we stretch here and we want to get it at a 105 credit. Well, now all we're going to do is we're going to go in immediately as we've already built the first order to enter, and we're going to build out our exit order or our profit taking order. So we're going to go here to the 115, 120, and this time we're going to buy the vertical spread back. So that's what we would do to exit the trade. To enter the trade, we'd sell the spread. To exit the trade, we buy it back. Now this is going to be our profit taking order. And in this case, we're going to buy it back once it's decayed in value about 50%. That's usually what we try to do with some of these credit spreads. So we're going to place that contingent set order that says, okay, buy it back. If it gets filled for a $105 credit, buy it back for a $50 debit, which again, this would be our profit-taking order or profit-taking part of it, like we had looked at in the graph on our slides here. We're also going to place our stop loss order if you want to use one. We do not use one all the time, but this is how we would place it. If you want to place a stop loss order, you go in and you do the same thing. You go over and create a buy order. But in this case, instead of using a limit, you'd say, I want to use a stop. So in this case, we're going to use a stop order that says, okay, look, if the value of this spread goes up from $100 or 105 up to $200, I want you to get out of the trade. Okay, so now we have both sides of the exit kind of covered if you want to do this. Again, this is just an example here. It's not necessarily exactly how we do it, but it kind of proves the point of how you can use these contingent orders. Now remember, this is all based on the first triggers all of these. So once this first order gets filled here, and you got to build it out in sequence, then these other 2 orders will work until one of them are filled. Okay, that's how it will work out. So if I hit confirm and send here, you can see in the order confirmation and dialog box, it has your first order, your second, and your third. And it says basically, okay, we're going to sell this vertical spread in Apple only at 105. And then it's going to place these 2 other orders triggered TRG by number 1. So these 2 orders right here are only going to be working and triggered if we get into Apple's original trade or this original call spread. So that's how this multiple contingency order can work. And again, you can have multiple kinds of orders behind here. You can have 5 or 6 or 10 different orders behind you. I think it can get a little crazy, obviously, but we usually like to do maybe 1 or 2 of these if we ever do them, okay? So now let's move on to OTO, which is one triggers other. Now this is going to be a little bit different because instead of a multiple contingency where you have 2 orders working at one time, you're basically going to say to the market, look, I want you to basically trigger a new order after just 1 order gets entered. Okay, so it's like a mini portion of the multiple ones that we just looked at. So basically you'd say, okay, look, if the stock is trading at, some price point here, which is number 1, then I want to buy at a price point of, say, $30. So when the stock drops down to $30 or when the option value drops to whatever, I want to buy in. And I also then want to set some sort of trailing stop limit or some order profit taking target, whatever the case is. I want one order, meaning the order entry, to trigger another order behind it, but only one. So one triggers one other order, or OTO. Again, if we go back to our charts here, we'll get rid of this order entry. We'll say, okay, we're going to get back into this call credit spread in Apple. So we're going to sell that as our initial. Now this time, instead of using a first triggers all advanced order, which basically triggers all of these multiple orders to work at the same time, we're going to actually build out a sequence of orders, or OTOs. So one triggers another, which triggers another, which triggers another. And again, you can go as far as you want with this. Now, in our broker platform with Thinkorswim, it's called first triggers other, or first triggers sequential, or other brokers might say OTO or one triggers other, but whatever the case is, just look for that, one triggers another type order sequence. So in this case, we're still going to say that we're going to sell this thing for $105 just to keep everything the same. And we're still going to build out our buy order as our profit target. So we still build out that same profit target that we had before of buying this back at $50. So if I confirm and send, just to give you an example of this, and then we'll build out more, you can see that first order of 105. Once that thing gets filled, then our second order goes in as our profit taking order, and it's triggered by the entry of order number 1. Okay, so that's all the same. Now where it becomes different is, let's say that after you make money on this trade, and let's say that number 2 order gets filled, meaning you're out of this trade completely with a profit. Let's say for some reason you think that Apple is going to be lower by that price point or by that time because you made a profit, and now you want to go in and you want to buy a debit call spread in Apple. Okay, so now instead of selling a call spread, you want to go in and buy a debit call spread. Again, I'm just using this as an example. This is not what, something we would do. I'm just trying to prove the point here. So if you wanted to, let's say, go back in and buy a debit call spread, I'd say $1 or $3.50. Now when we see this order dialog box, you can see it's a little bit different, meaning that every single order is triggered by the one above it in sequential order. So if we enter this trade and we sell this call spread at 105, then it's going to enter this order to get us out at $50, again, triggered by the order entry of number 1. If we get out of the Apple trade completely with a profit, then we might want to go back in and buy a debit call spread, assuming that the markets come down or whatever the case is, but that order is only triggered once order number 2 is filled. Now this is different than our multiple contingency orders, where we had both of these orders going in at the same time, triggered by number 1. In this case, each one is triggered by the one above it. Again, you can get pretty creative, and I've seen a lot of crazy things happen here. We don't get all too fancy with everything here at Option Alpha. We usually have maybe one triggered order behind it as a profit-taking order, and we'll go through that more in track number 3. But we rarely will do multiple contingencies like this. We just like to know exactly what we're getting into or not. There's no assuming that you know what this price point is in the future. But again, I want you to understand how these multiple orders can work and how these different order types can be used. Now, the last one that we're going to talk about is one cancels other. Okay, now in my opinion, I think this is a much better way to go about trading, because you're basically going to enter 2 orders at the same time, and the fill of one order will cancel the other order trying to get filled. What I usually like to do in this case is I usually like to enter these orders when I'm trying to get into a trade, and I'll try at 2 different strike prices on either side and basically say, look, whichever one fills first, I'll take that trade. I don't want to take the other one. So for example, if a stock or some, option is trading at, say, price point 2, it'll say, look, I want to sell it here, or I want to, basically buy it at some other price point. But if I get sold, meaning if the stock gets out, I want to cancel my additional buy order down here. Okay, so that's basically what it means, is that one order getting filled cancels out the other one completely, and you don't have these kind of trailing orders out there in the market. So again, if we're going to use that same strike price before that we used for Apple, where we sold the 115-120 call spread, what we're going to do now is go down to OCO. So in this case, right here on Thinkorswim, there's an advanced order type called OCO, which is one cancels other. And we can basically place 2 different orders in the market. So let's say, we wanted to place 2 different spreads or 2 different spread trades, and we wanted to sell a call spread or a put spread, and we didn't really care which one gets filled first. So in this case, we could sell the 115-120 call spread and get $99, or we could sell the 100-95 put spread and get $61. They have different probabilities of success, but for the sake of just making this really, really simple in this video, again, let's assume that we don't really care which one we get filled. All we want to know is that we're getting into one of these 2 contracts, okay? So we might stretch a little bit here and say, okay, if I can get into the call spread at 105, or I can get into the put spread at 70 cents versus 60 cents, I'd be acceptable at either of these 2 ranges. Now, when I hit confirm and send here, you can see that both of these orders are going to be placed in the market at the same time. Okay, that's the difference here with OCO, is that both orders are actually working at the same time, which is different than contingent orders, which have backup orders that only get placed or are only working if the first order gets filled or if the sequence of orders get filled. With OCO, both orders are going to get placed into the market, which means at the same time, you're going to be trying to fill the call spread and the put spread. But the key here is that whenever one of these orders gets filled, then the other order gets canceled. So let's say, for example, that both of these orders get working and immediately your put credit spread gets filled at 70 cents. Well, then the system will recognize that you want to cancel out of your credit call spread immediately because the first order got filled right away. Okay, so this is a great way to make a lot of assumptions about where markets might go and kind of place these contingent orders. And you could place, 3 or 4 of these within the same security as long as you do one OCO, which means that if any of these trades get filled, then I'm out of the trades, all the other trades altogether. Another way that you could do this is you could do a strangle on top of this as well. So you could say, okay, I want to do the credit call spread, the credit put spread, or I want to do the strangle at, let's say, 95 and 120 for $127 credit. Again, it doesn't really matter. All 3 of these orders are going to get placed in the market at the same time. As soon as one of these orders gets filled, so let's say our put spread gets filled right away, then the strangle order gets erased, and so does the credit call spread order gets erased. Again, because that put spread order got filled. So this is one that actually sometimes I will use if I'm not right in front of my screen and don't have the ability to trade. So if I know I want to get into something in Apple, and as we've talked about here in track number 2, it really doesn't make a difference which way you trade it. Generally, you're going to have the same probability of success and payout and all that stuff. It's going to be fairly equal across the board. So if I want to get into Apple and I don't care necessarily which trade I get into as long as I get into one of them, then I might use an OCO type order to basically place this, kind of use these credits to kind of like stretch the market and see which one gets filled at the highest price. And if that price gets, or if that order gets filled, it cancels the other 2 orders. Okay, so I don't use this all the time, but it is something that you can use. Again, this is great if you are working a day job or don't have the ability to watch the markets all the time. You can basically set your pricing based on the pricing stuff that we've talked about here in track number 2 and use these contingent orders to your advantage to basically set up these multiple situations to enter, but it'll only fill one of the contracts and again, keep your position size and risk size controlled. So here's the deal. Even beyond these 4 main types, there are lots of variations. You probably saw as we were going through this video, there's triggers with OCOs and blast orders and pairs orders. There's a lot of different variations on order types and advanced orders. but you don't need to use these to be successful. I can honestly tell you after doing this for a very long time that 99% of the trades that we place that are order entries are just using a very simple single order. Now that's my style. That's the way that I like to trade because I want to know what I'm getting into. And yes, we may use a small contingency of a single order, meaning fill at this price point, which may be $5 above or below the market or whatever the case is. But for the vast majority of the trading that we do not use a lot of contingent orders. However, I do feel that it's important to go through these so that you understand the concept as we move further through track 2 and then eventually get to track number 3 where we're talking about trade exits. That's usually when contingent orders start coming into play a little bit more, is on trade exits, as you probably saw in this video. It's a big topic. I get a lot of questions on it. That's why I thought it was really important to cover in this video. Again, most of the trading that we do here is with single order types. Now, again, I appreciate it. Thank you so much for taking a look at this video. If you have any comments or questions or feedback, let me know in the comments section right below. If you love this video, thought it was helpful to kind of clear up these contingency order questions that you might have had, please help us by sharing this video online, spreading the word about what we're trying to do here at Option Alpha. Until next time, happy trading.